That would be a family show. Um, Jeremy, yeah. So Jeremy, I'll just wait for him because he's one
Yeah.
of the guys who actually wrote to me. So,
Yeah, I'm coming.
is-
I'm here. It's just my, I should be on my phone. Yeah.
okay. So, guys, in general, just for as I say, Jeremy, I like everyone to have the video on if possible. I prefer to talk to humans, not to a black screen. And secondly, guys, if there's
Yeah.
background noise chez vous at your place, maybe just mute it when you're not speaking. By the way, I'm not a big fan as well because I'm old school of text and the chat. So if you guys have something to say, just hit the speak button, the audio button, and say, hey Angus. Like I prefer just to react to people talking to me rather than endlessly checking chats. I don't really check the chat. Okay, so yeah, so let's get into it, guys. Who has some questions? So let's try and do this for an hour or so, and I'll do my best. I'm not saying I'm an expert on everything, obviously, but if you guys have a more like a theoretical question about something, maybe I can do my best. Who wants to start?
Uh, do you hear me?
I can hear somebody. Please tell me who you are. I don't know
Uh,
who me is.
I'm Jeremy.
Okay, Jeremy. So you're the guy who
Yeah.
wrote to me, right?
Yeah, I wrote to you like some messages for basically like a revision on like what I'm learning in the macro stuff,
Okay.
and pretty much there was some aspects that I didn't understand.
Okay.
And so I just wanted to like get it was mainly the stuff on a lot of things on backwardation and contango. So I remember in one of your oil videos,
Yeah.
um, and sometimes I
Let's
would be
stop there.
watching your
Something very,
webcast.
sorry, Jeremy, I'm just going
Yeah.
to stop you there. One thing, guys, which is super important, when I used to teach a lot at EUTAF back in the old days, um, it's very important that we understand terms, okay? Feel free to interrupt me or anyone else if you don't understand a technical term. So I'm imagining that some of you are not familiar and comfortable with the expression backwardation or contango, right? Does everyone understand what backwardation and contango is or no? No? Yes? No? Okay. Melissa's shaking her head. That's good. Okay, so very quickly, guys, an important thing to understand about, I would say, especially commodity markets, is this idea that if you know for futures, and Jeremy was talking specifically about oil, every month has a different contract, right? So you have, like, for example, at the moment, December. And what does that mean? That means oil which the contracting parties agree to deliver in a certain month. So if you're trading oil, let's say like December, that is for December, like literally in the real world, that means for December delivery. Okay. But we also have, January, February, March, April. Now, the point is, this is not so important for, actually, technically, it is important for every single contract. We also have the same thing for NASDAQ. For every futures contract has different delivery dates. But the point to keep in mind, especially for commodities and specifically oil, is that different parts of the curve, which we call the curve, has a different price. So the question is, we call that the curve. And so what do we mean by that? So if we just immediately have a look at a couple of oil contracts, is this okay, Jeremy? This is the way I like to talk. I'm a little
Yeah.
bit
Yeah.
round.
Yeah.
I'm a little
Yeah.
bit roundabout here.
Yeah. Let's
Okay.
go.
So let's go. So the thing is, guys, when you're often trading, uh, and again, I know that you guys have different levels of experience. So I'm looking after some birds for a friend of mine, so it's a bit annoying. I've got birds for 2 weeks. That's okay. Anyway, so I don't know if you can hear them, but I've got stupid perruche in my head. Okay, so if we go, hold on, sorry guys, I'm just finding my oil chart here. Enrico, he's a guy from the old days. Okay, so if I put up this chart, guys, this is a day. Actually, this is a daily chart for what we could call North American oil, WTI. So what does it say up here? It says CL1. What does that mean? CL1 is the front contract or the closest contract for delivery. Do we know which month it is from looking at this chart? No, we don't. It says CL1. It's just telling it's the first month, so it's the closest delivery. So first of all, just a quick trick. I mean, you probably know this, but on TradingView, you need to go into the security information, and we see here that it's for F. And that's the symbol, of course, for January of 2026. Okay, great. So the point is that what we know is that the front contract, which in this case is January, that means oil which is going to be delivered in January. It's trading at this price, 59.88. But what we'll see, if we actually start going into the different futures contracts, so for oil, and I'm going to keep on oil, you can see that we have January, which we just looked at. But let's say, for example, February, right? And you can see that February is not actually the same price. Okay, so what's going on here? What's going on is that if you look at something like the oil curve, depending on the relationship between the front contracts and the contracts for further out delivery, that gives you quite valuable information about the strength of the market. Okay. Now, what Jeremy was just referring to was backwardation. So backwardation is a situation where the front contract, in this case January, the front contract for immediate delivery is trading at a higher price than, let's say, the second contract. So let's say February and maybe the third, et cetera. Okay. In that situation, the front contract is higher than the other contracts. And we call that in backwardation. Backwardation is when the front contract is trading at a higher premium or price to further out deliveries. Now, the opposite of that is contango, 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 just a technical term. Contango is the opposite. It's when the front contract, or maybe that's there. Anyway, the front contract is trading at a cheaper price to further out deliveries. Okay? And that's the shape of the curve. And you guys, if anyone has ever watched my videos in the morning, I sometimes show these curves, right? Why is this interesting? Why is this interesting, Jeremy? It's interesting because if the front contract for immediate delivery, or let's say next month's delivery, is trading at a more expensive price at a premium, that is telling you something about the market's demand, the physical market's demand. It's saying that the physical market is prepared, is willing to pay more money than a contract or oil which is going to be delivered in the future, right? So the first thing is that if you're trading any commodity, but specifically I would say energy, things like nat gas, gasoline, and oil in particular, and actually other commodities, you need to understand the curve, not just the price. The price is telling you a lot of information. When I say the price, I mean what we call the outright price. It's just the naked price. So if someone says to me, oh, what's oil? I can look at the front contract and go, oh, it's $59.50. Great. But what's actually kind of more interesting is actually also to look at the shape of the curve, because the curve will tell me the underlying physical market of crude oil reality. Are people desperate? And I like to give an example. When I was teaching, I always like to give this example. Imagine that, I don't know, a cold drink or beer, cold beer is like oil, okay? If someone knocks on your door on a Tuesday afternoon at 2 p.m. in Montreal when it's minus 20 in January the 5th on a Tuesday afternoon, and they say, hey, Angus, hey, guys, I have some beer to sell to you. Are you interested in taking delivery for that? You go, it's minus 20, it's Tuesday, I don't need any cold beer. But what happens if that person said, hey, what about taking delivery for a Sunday afternoon in August at 3 p.m. when it's plus 35 degrees? Jeremy, would you have more interest in taking delivery of that beer in August if you had a
Yeah.
barbecue? The point is, that's exactly like the oil
Yeah,
market
yeah.
or a commodities market. So the point is that, let's say we look at beer, cold beer for barbecues. I would probably say that the curve would be in contango on a Tuesday afternoon at minus 20 in January. No one wants immediate delivery. The market is not interested in paying. They'll say, I'll give you $1 for that beer. But possibly the price of beer for an August delivery on a Sunday afternoon when it's plus 35 degrees, people are desperate to get a cold beer. They'll say, okay, I'm happy to pay more than $1. I'll pay $1.55. In that case, the curve would have a very different shape. It would be in contango, which means front month deliveries are cheaper than further out deliveries, right? On the other hand, let's look at oil. So is this making sense, guys, in general, for what the curve is trying to tell you? Okay. So the first point I want to make is for Jeremy is this idea that if you're looking especially at commodities, you need to understand what the curve is telling you. Here's my point. Even if the outright price goes up, so let's look at a curve, and I'll bring up, for example, one which a lot of people trade. So we can do, so let's go into TT, not TT. So can you guys see my screen here? Yeah.
Yep.
Yes.
Yep.
Okay. So what I'm going to
Yes.
first of all do, CL oil futures. Okay. So I want to see kind of how the market is thinking about oil today. So I'm going to put in, let's say, January. Okay, so you see I've got the January. Look at the January price, 59.92. Okay, great. But what's actually kind of interesting to me as well, look what I'm going to do here, guys. I'm going to subtract, you see in TradingView, subtract, I'm going to put in 6 months away from now. So I'm going to put in, let's say June, which is quite a liquid contract, okay? June, see that? June, M 2026. I hit enter. So you see what I've done here? I'm going to subtract the June price from the front contract, which in this case is basically January. So I hit that, and what can you see? You see here, what we're seeing here now, 41 cents is the differential, or just the difference, between the January contract and the June contract. Okay, is this positive or negative? This is positive. So what that is telling me, this is a daily chart. What that is telling me is that at this point in time, people are prepared to pay 42 cents premium for a January delivery of oil compared to a June delivery of oil. But the point I'm trying to make here, guys, if you actually look at this chart, if we put this, let's say, there, so this little dotted line is zero. What happens below zero? It's negative. So if we just go back, I don't know, a few months, what can we observe? We can observe that at certain points, for example, April and May. Now look at this, guys. When did our friend Donald Trump announce all those tariffs? Remember Liberation Day? I think it was April the 3rd or the 4th, right? Now, what can you notice here about the spread between these two contracts? As our friend Donald was talking, it was about $1. The market was, for immediate delivery, was paying a $1 premium, but it went negative. It actually went negative, went down to about minus 90 cents, minus $1. And even as recently as, what's that, about a month ago, October the 21st, it went down to minus 70. And then it's come
Hmm.
up, and then it's coming down. So what's the point of all that? What is that telling us? The point is saying that why would a spread, the front contract, be more expensive, so therefore in backwardation, compared to a further out delivery? Give me 2 or 3 reasons. Melissa, it's turning into a class already. Well, like,
Okay, so
and
repeat
think
the
about it this way.
question.
So the question is very simple, because this is the point I'm trying to make, guys, is that when you're trading oil, you need to keep an eye on the price. Great. But you also need to be understanding what is the market sentiment. And one of the most powerful ways of looking at that is the spread between different months. So when do you think, Melissa, or anyone, let's explore 4 or 5 scenarios in which people would want to pay or be happy or willing to pay a premium for front month delivery. What are some classic examples of that?
Upcoming deficit. So we expect
I was
deficit.
gonna say, yeah.
Yeah, I mean, in a more general sense, that's so do you mean deficit in terms of supply and demand?
Yes,
Yeah,
correct.
exactly. So of course, in the oil market, like many physical commodities, one of the key issues, of course, is supply and demand. So yeah, so I think it was Alex who was speaking. So as Alex was saying, absolutely, if the market perceives that there could be an imbalance in immediate supply, either way, plus or minus, that's going to cause the market to have a little mini freak out, or not a freak out, that's a bad expression. We'll just readjust. So what could cause that? It could be many factors. The classic factors, it could be, well, let's just go through them in the case of oil. Let's say, for example, OPEC Plus decides to reduce production. The market might say, oh, whoa, less oil. Therefore, we're going to pay a premium for oil which is available. Also, it could be a terrorist attack. And for example, recently we saw, actually we have been seeing, they're still continuing, the Ukrainian drones are kind of trying to destroy a lot of the Russian export refineries and the export facilities over in Crimea. So the market gets a bit nervous about that. Okay. We also, a classic example in the oil market, but actually specifically in, let's say, the gasoline market, is, in the Gulf of Mexico. Oh no, you have to call it the Gulf of the Gulf of America now. The Gulf of Mexico.
America.
The Gulf of Mexico. If there's like a hurricane and the market believes that there could be a reduction in crude oil production, generally the front months will spike. Okay. And of course, vice versa. Now, in a more general sense, it could also be global demand. So that could be an OPEC Plus report. It could be an EIA report. It could be an IEA report, or it could just be a general sentiment. So as we just saw, when Trump started, doing all his tariff stuff, the market in general went a little bit risk off, but more specifically, the market was saying, maybe there's going to be less economic activity globally, therefore less oil demand, therefore there's less premium we need to pay. We could be getting into a glut or a surplus or an oversupply. So the point is, guys, getting back to trading, does that all make sense? Any questions there? Okay,
No, it's all good.
so the question is, who cares, Angus? Like, why? That's all very cute. That's all very interesting. But why are you telling me this? I'm telling you this, A, because it is interesting, but B, most serious oil traders, the first thing you need to look at every morning is to understand the curve. You need to understand the curve. Is the curve moving up? Is the curve moving down? Okay. Is it steepening into a backwardation structure? Is it moving downwards? And so you can see that, I mean, TradingView is not perfect. But for example, the one I like to look at, and a lot of people like to look at, is like December, just to get the sentiment. So what you can see here, I mean, what can you see here, guys? You can see that December Z2025 to minus December 26, it's kind of in a range, right? Now, for example, why did it spike up here? Do you guys remember what happened 11th of June, if I remember correctly? What happened here in these 2 or 3 days? What caused that to spike up? Anyone remember? If my memory serves me well, that's when Israelis and the Americans bombed the Iranian nuclear facilities. Remember that huge bunker bomb, which the Americans dropped on the Iranian nuclear facilities. Okay, Iran, as we all know, is one of the world's major producers of oil. It's number 4 or 5 or 6, if I remember correctly. And there was a concern that Iran might block the Straits of Hormuz, which is where a lot of the world's oil transits through, and basically, let me just check something. I think some people have access. So you see that went up. It was trading at basically flat. See that zero, and the premium of the front contract or the closer contract went up to $4. That's 420 ticks. Now look at this, guys. When the all clear happened, and I think Trump came out and tweeted something like, oh, it's all over. I was just having a bad day. And the Iranians came out and said, oh, we're not really going to retaliate in other than sort of a politically symbolic and theatrical way. Look what happened to the spread. It went from a $4.50 premium, in Jeremy's terms, a backwardated state, and it went all the way back down. The premium went basically down to zero. Look at that in 2 days. So it went flat. Now, also, at some points, you can see here, look at this, it's actually gone negative in basically in October, the middle of October, it went negative. What is that telling you? It's saying that the front months is actually people don't want to pay any longer a premium. In fact, they want a discount. They're saying, hey, we want a dollar discount of immediate. If the market wants me to accept delivery for front contract oil, I want a discount. Now, is that good or bad? That's very weak. That's telling you the market is weak, structurally weak. And I forget exactly why it went down there, but it could have been, IEA reports like OPEC Plus saying they're going to produce more. OPEC Plus as well, about 5 or 6 days ago, I think it was, if I remember well, basically came out and they said that rather than the market being about 400,000 barrels a day in a deficit, was actually now going to be in a surplus. And the market went, oh my God, there's too much oil. There's a surplus. Nicola, go ahead. Remember, you can just speak, Nicola. It's all good. Just
Oh
interrupt
yeah,
me.
my bad. Just a question. For the October, when it went negative, do you think that had something to do with the ceasefire with Israel going into effect in October or no?
It's a small factor. Yeah, good point. Yeah, definitely oil is one of the markets which is extremely sensitive to geopolitics. However, let's think about Israel and Gaza and Palestine. And I'm not going to get into the politics of it at all. But what I would say is that the oil market is intelligent, and therefore it only reacts on geopolitics. Well, let's put it this way: the degree of reaction is directly proportionate to the potential disruption to the oil market supply. Does Israel produce oil? No. Well, a tiny, tiny bit. Does the Gaza Strip produce oil? No. So in that sense, this whole conflict between Palestine and the Gaza people of Gaza and Israel, it hasn't had a huge effect on the oil price. Having said that, it has had a kind of a ripple effect because the concern about Israel and Palestine and Gaza is always that conflict could reverberate wider to Iraq, to Iran, obviously to Saudi, maybe the Iranians blocking the Strait of Hormuz, maybe the Red Sea, sorry, the Suez Canal being blocked, etc., etc. So your question is a good one. Is that part of the factors? Absolutely. Is it a major factor? Not as much. For example, I remember 4 or 5 years ago, there was, I think the Houthis, they had a drone attack on one of the world's largest refineries in Saudi Arabia, and the market ripped like hugely high, $4 or $5 higher overnight. Okay, Saudi Arabia oil is not the same as Gaza, right? So yeah. Okay, any other questions on that, guys? No. Okay, so in terms of trading, why not just trade oil? Say, okay, Angus, whatever. Why? Now, do we all understand that you can trade the spread, just by the way? Do we understand that? Miguel's shaking his little finger there. Okay. So the point is, guys, how do you trade oil? You can trade oil in many ways. So give me a few ways. Jeremy, how do you trade oil? When I say how, I mean which instruments. To express an
I mean, you
opinion on the
you,
oil market,
you,
how could one do that?
you I mean, you can use the crack spread, like
Mm,
with
mm, mm,
nat
mm, mm,
gas
mm,
and
mm, 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 mm.
no,
Futures
nat
contracts.
gas, no,
Whoa, 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 whoa. The crack spread
futures.
is a completely um, so it's a related subject, but
Yeah.
it's not what we're talking about. The crack spread is a much more technical spread between the different products and stuff like that. So that's
Oh,
maybe for another class.
okay.
Yeah.
Yeah. Okay. Sorry. You could. Yeah, like Melissa was mentioning. Yeah, the few you can trade futures.
Okay.
Mhm.
So what is it? Okay. So when we say the futures, what does it mean, the futures? Let's be a bit more specific.
Futures contracts.
Okay. So where do you trade
You
those?
want to be more specific?
So which futures contracts? There are three futures contracts for oil, WTI oil.
You can trade the Brent.
Okay, Brent. So what's Brent oil? So the first thing to understand as well, guys, is that when we say oil, there are hundreds of how can we say different grades of oil globally. So I'm not going to overcomplicate it, and I'm not going to be annoying, but just keep in mind that chart which we look at, CL, is actually WTI, West Texas Intermediate. So what you're essentially trading is one of the principal North American benchmarks as priced in Oklahoma. This is not Brent. This is not Dubai. This is not Russian oil. So by the way, everyone's talking about Russia, and it's like, oh my God, Russia and sanctions. We do understand that Russian oil is primarily Urals grade, a specific grade of oil which comes out of mainly Russia. So in fact, the main effect of all these sanctions is on the spread between the Urals, the Russian oil, and Dubai, the Middle Eastern benchmark. Let's put that to the side. So when we talk about trading oil, we can trade, let's just keep it simple and trade the main US contract, which is WTI. Okay, so we have the full futures contract. How much is that per tick? $10 per tick, per cent, right? Okay. Is that an easy product to trade? Who's actually traded that for real money? Who has traded the full WTI contract for real money?
Mini?
Okay, Yassine and Miguel. Okay, so the point is, guys, is that an easy product to trade, Yassine?
No, it's not an easy product to trade. I used to trade oil after the DOE numbers,
Okay.
and it was much more trickier and much more volatile.
Exactly. It's a very big boy or big girl product. It requires a pretty big account size. It's very volatile, and you can make a lot of money or lose a lot of money. So unless you have, I would say, a pretty big account and a strong stomach, it's not easy just because of the volatility and the shakeouts and everything. Okay, as Miguel was saying, you can also trade 1/10 of that, the micro MCL. There's also a mini, but let's say the micro, which is 1/10. That's all good. But the point is that you're always going to have a lot of volatility, right? Okay. How else can you trade oil, guys? Just while it seems to be turning to an oil chat.
Back in the time, Angus, I remember, and this comes from IOTF, they used to trade the report or the DOE on Wednesdays, right?
Yeah,
Based on an inventory of American oil, which is CL, saying like, well, let's see what the report is, and we'll go, based on if there is deficit or
yeah, sure. And that's what Yassine was just referencing. Absolutely, that's one of the import factors. But my point, I'm trying to understand, Miguel and everyone, is really the instruments you can express a view on oil. So you can do it through futures. What
You
else?
can ETFs.
ETFs. So for
CFDs.
example, you can use an ETF which tracks oil like USO. You could do a leverage ETF. I know Marco, for example, I think likes to use like SCO, I think it is, and things like that. You could also do it through ETFs in a more general sense of oil producers. It's a bit, it's not exactly the same thing. And of course, you could do options on those ETFs. And of course, you can do options on futures. I personally trade options on futures, right? So you use the futures as an underlying instrument, and you trade the options on futures. So I trade options on oil futures when I trade oil, because it's just a lot easier to manage, right? Rather than trading the futures. But my point is, guys, another way is to trade the spread. This is why I'm getting this subject. You can trade the spread because the spread is less volatile and will enable you to stay in the trade longer. And it forces you to have a fundamental reason for the trade, right? Rather than like, oh, I like this level in oil. If you believe that there's an oversupply of oil or a geopolitical shock, or, for example, an overextension. For example, one of my favorite ways of trading oil is when there's a geopolitical shock. So, for example, when the Americans bombed Iran a few months ago, I was listening very carefully to the rhetoric coming out of the White House and also the Iranian political leadership. And in my humble opinion, I thought this is just political theater. The Iranians will not do a substantial counterattack. And therefore, that premium is overextended. It's too much. It went up for a day or two. Everyone's going, oh my God, there's no oil. But then the market would quickly take that back. So how could you have expressed that opinion? You could have shorted the futures, either the full contract or the mini, or you could have bought long put spreads on SCO, or you could have you could have bought puts on the futures on oil futures, or this is my point, you could have traded the spread. So you go short the front contract, which had spiked, and you go long the second contract, right? So if there's a shock to supply, and the market suddenly freaks out and thinks, oh my God, well, there's not going to be any oil, you go long the front contract, and simultaneously you short the further out contract, and that can be your choice. the greater the distance between those two contracts, the greater the volatility. Okay. And if you think it's going to reverse, you do the opposite. So you short the front contract and you go long. Now, keep in mind, these products, these instruments, these months are highly, highly correlated. My hands, they move together. So you're just trading the spread. You're trading the differential. And if you look at that Iranian situation, for example, you can see here at this point, after a day or two, you're like, okay, this is done. And then basically at this point, when it's at maybe $4 or so, you say, you know what? This thing is going to come back and calm down a little bit. So you short, in this case, you could have shorted whatever the front month was, and you choose a month, the next month, or maybe 3 months away, and you go long that, and that'll basically come back into equilibrium, which it did. And as you can see at the moment, it's pretty flat. So, Jeremy, long answer, but I always give long answers. Does that clarify things? My point is, guys, there's 2 points here, just to finish off. Talking about calendar spreads, which is what this is, it gives you a sense of what the market is trying to communicate. And here's the point, guys. If the front contract, just the basic price, let's say it goes down 20, 30, 40 ticks at 9 a.m. when the market opens for oil. And you go, oh my God, oil's coming off. But if the spread has remained flat, what is that telling you? That's telling you the market is still quite strong. So for me, that would be a buy the dip situation. Whereas let's say the outright market has gone up in price, but the spread is actually flat or a little negative. I'd go, that's weird. The front contract month is going up in price, it's squeezing, but the spread is not going up in price. That indicates structural weakness. So the way to think about the shape of the curve is to think about what is the market, the structure of the market. Is it structurally strong, or is it structurally weak, or is it flat? And that's why you should always, when you're trading oil, always have the spread up. You should have 2 or 3 spreads. I have CL1 versus CL2, so the front month versus the second month. I also like to have a longer dated one. So let's say CL1 versus the whatever 6 months away. And then what the industry follows in serious traders, hedge funds and everything is actually often December. That's kind of like the benchmark spread. It's kind of, you always be looking. So at the moment it's a bit tricky because we're about to, go away from December 25. So it'll actually, I'd maybe do something like January to December or. So you see, and you're always looking at those spreads. And if the spreads are constantly positive, that's telling you that the physical demand is still quite robust. Make sense? And of course, you've got other things like the crack spread and gasoline, and that's a whole other thing. Does that make sense, Jeremy? Does that answer a question?
Yeah, makes sense. Yeah. It's just what I'm curious of is like the aspect of the curve, like when you see let's say you have your chart open and you see I guess a contango
Okay, so let's remind ourselves,
situation where
contango is
it's
when the front of the curve
cheaper.
is cheaper than further out delivery. That is saying, well, what is that
Yes.
telling us? That's telling us the market is not prepared and has no desire or need of immediate deliveries. So it's a weak market. It's a weak market. So that's giving me a structural bias to short rallies, for example, because it's telling me the market is not prepared to pay a premium
Right.
for or for immediate. When I say immediate, I mean, the front contract deliveries at the end of the month. And so, for example, I mean, I'll give you a theoretical example, which was like a crazy exaggerated example. So during COVID, guys, remember COVID, that interesting time in our lives. What happened pretty quickly to the world economy? It shut down. Remember, no aircraft, nobody was flying, industry shut down. There was a huge reduction in economic activity. Do we agree?
Mhm.
Great. So what are the implications
Yeah.
for the oil market? Horrible, horrible,
Yeah.
right? No more planes flying, industries shut down, etc., no one driving. So, because I was trading this, I remember very clearly. What would you say the shape of the curve in December of 2019, January 2020, so before COVID hit, what was the shape of the curve? I can tell you. It was in a strong backwardation. What does that mean? It means that the front contracts were up here, and the further out the curve, they were much cheaper. What is that telling you? The market was prepared to pay a premium for quick delivery. Everything's good. The market's strong. Okay? It's like ordering beer on a Sunday afternoon in August for your barbecue. You say, I want it now. I'll pay a premium. Okay? What happened to the curve as soon as COVID started happening? What happened? Danilo, I think you look confused or concentrating.
Contango. No, no.
Yeah,
They don't
contango.
need the oil right now, so they will have to hold the oil for longer.
Yeah,
Ships are gonna have to float with oil for a long time. It's gonna cost money, so it's gonna be more expensive later on.
exactly. Perfect answer. So that was a very simple example and a very dramatic example. The curve went from a crazy backwardation within, I don't know, 4 or 5 days. Not, of course, all the price went down. Don't get me wrong, guys. The price of every contract went down. But what I'm trying to say is that the price of the front contracts, boom, reduced substantially more. So the curve flipped like that into a crazy contango. In fact, it went very, very negative.
Yeah.
So what's the trade? If you're a good oil trader, and one of the world's greatest and biggest oil traders, a French guy called Pierre Endurant, his trade, he made about $2 billion on that trade. He went, oh, no economic activity. The curve will flip. So very simply, you short the front contract and you go long maybe 6 months away or 12 months away, and you're trading the differential. So you don't actually care. And the point I'm saying about trading these curves, guys, is that you don't have that crazy intraday volatility. You don't care actually if the price goes up and down. You care about the differential. That's why it's a beautiful thing to trade, because you're not sitting there going, oh my God, I got stopped out because oil went down 100 ticks.
You're basically hedging your position.
I wouldn't exactly agree with that, Danilo. Why don't I agree with that? Hedging, you're trying to remain flat. So you're correct in a sense, but really this is an active trade in the sense that you are making a trade. In this case, let's say in the COVID situation, that the front contracts will lose more value than, let's say, the further out contracts. So it is an active trade. It's a directional, well, it's not a directional trade. It is a differential trade. So remember, a hedge, your goal is to remain neutral on your profit and loss, on your P&L. So in a sense, it's hedging, but remember, a perfect hedge, nothing happens. You go, oh, I didn't make or lose any money for 6 months.
Understood.
So would it be considered a form of arbitrage then?
Yeah, you can use. Just a second, guys. I have someone at the door. I think it's a courier. Just take a 30-second break. Sorry about that, guys. Had a insurance document. Okay, so arbitrage, Melissa. Yeah, I guess so, but no need to overcomplicate that. I want you to think in terms of supply and demand. And what I'm trying to say, guys, is that, for example, Yassine earlier was saying, oh, oil's it's very volatile. And anyone who trades oil knows that it can go up and down 200 or 300 ticks. And it's very easy to be stopped out. So if you're not going to use options on futures or some other instrument, if you want to trade the futures, what I'm trying to say, guys, as a trading instrument, the spread not only gives you extraordinarily important information about the underlying sentiment of the market, but it's a great way to trade. Let's say, for example, you're trading, you're in front of your computer, and you hear, for example, when Russia invaded Ukraine, remember that? I think it was March of 2022. What's going to happen to the oil price? It goes up, right? Now, I was actually trading that night, and if you look back on the chart, of course, everyone goes, oh, wow, I would have made so much money. But the problem, guys, is that in that very, very volatile situation, just the basic contract was going, it was very, 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 very volatile. A cleaner way, a simpler way for us to trade. And again, guys, we have to distinguish here between a hedge fund which has like a $500 million account and maybe us, right? Of course, if you're a hedge fund, you just click and kind of go away and have a cup of coffee. And if it goes down, $100,000, you go, okay, no problem. This is going to go up. You see what I'm trying to say? Guys, I just want to check. I think, is anyone having problems getting in? No, it doesn't seem so. Okay, that seems fine. You see what I'm trying to say? An easier way of doing that, if you hear some kind of geopolitical event, is to say, hey, I'll go long the front contract and short a further out one. And on the TT, you can do that directly. They have a synthetic ladder. They literally have all the spreads. So you can just, it's just a question of click. You go click to buy or click to sell if you believe it's the other way. And I'm just trying to say, guys, it's a beautiful way to trade oil. And also, if you want to use other instruments, USO, blah, 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 SCO, whatever, understand what's happening with the curve. If the curve is going into contango, you want to really think carefully about going long oil. On the other hand, if the curve is flattening and going into contango, and maybe you want to be shorting rallies. You go, You see, it just gives you a bit of extra information. Okay. That's one question. All right. Anyone else have a question? How many people do we have? We just have 6 people. Did everyone else leave, or are there other people? How do I know how many people are here?
Yeah, I'm still here. I'm still here.
We're 25.
Oh, there's 25 people. Okay, I can only see. Okay, guys, let's have another question. We've got another few minutes. Let's do something else. Maybe not on oil. Does that help, Jeremy, on oil?
Yeah, completely. Yeah. No,
It's very simple. Think of
everything
it
is
as
good.
supply and demand. Just think
Yeah.
about it
Yeah.
as, and it's a stupid example because I don't even really drink beer, but I'm just trying to say, remember, beer being delivered on a Tuesday afternoon in January is not the same as the premium the market wants to pay on a Sunday afternoon in summer. That's it. Okay, any other questions? I don't know about life, bonds, the Fed, macro.
I can throw
Flatteners
in.
and steepeners.
Oh yeah, maybe we'll get, that's a big question. Danilo, sorry, what's your pronunciation of your name? I like to get people's names correct.
Danilo is fine. Danilo, whatever.
No, I prefer,
Dan.
what's the correct one?
Depends on what region you're from, but
I'm an
where I'm
Anglo.
from is
I'm an Anglo. So what would be a good Anglo pronunciation?
Danilo.
Dan,
Danilo, it's fine.
Danilo.
There you
Okay,
go.
what's your question?
So it's about spread. I have 2 questions, but let's go with this one with spread because you're on the topic already.
Okay.
There is the possibility of the Bank of Japan to intervene the yen, right?
Okay. First of all, in Japan, what I'm going to say, the Bank of Japan has historically been more, let's say, political than other central banks. Now, the reason I'm saying that, less independent, in the sense that the Bank of Japan historically has served as the instrument for the Ministry of Finance or the government. So when you said, oh, the Bank of Japan will intervene, there's a little nuance that actually it's the Ministry of Finance, which is the government, requesting the Bank of Japan to undertake certain operations. But so I take your point. Yeah, that's possible. They're starting to do verbal intervention. A lot of people say it could be about more like the 160 level, but yeah, go ahead. Possibly.
So how would be an interesting way to operate the spread between Japanese yen and US dollar.
Okay, I personally wouldn't really call that a spread. I would call that just an exchange rate,
Okay.
because remember that if you're looking at two oil contracts, they are fungible. It's the same thing. Whereas the US
Mm.
dollar is not the
They're two
Japanese
objects.
yen. So I don't know. It's okay. I mean, I understand your question. Okay, so let's look at a chart. Let's look at USD.JPY, which is here. Okay, so the question is, by the way, technically, I look at this and I think the US dollar is probably going to test up here. Okay, so let's talk about intervention. The Ministry of Finance, or we could say the Bank of Japan, as you probably know, they have different levels of verbal intervention. It's a very formalized process. Like literally for the last 50 years, they have different levels. They go, oh, we are watching with some interest, the exchange rate. Then if they're a bit more, they go, we are watching with some concern. We are watching with great concern. They literally have things, and I actually have a document somewhere. Someone did a historical study of the different, they used exactly the same language. Okay. It seems recently that when the Bank of Japan has intervened, uh, they generally intervene when the US dollar has a moment of weakness. Okay. So here's my point. It's not necessarily a specific level. It's more, let's say, for example, we have non-farm payrolls sort of coming out on Thursday. If that's weak and the US dollar weakens, they could intervene because they're trying to get more impact. Like if the US dollar is going down, like bang, they'll hit it more. Now, is your question what level, or is your question what could be a way of expressing that?
Would be more how to operate, how to profit from this.
How to profit? Well, that's the big question, of course. Okay, the danger is that, okay, so what I would do, I would look at the chart. Now, what's the problem here? If we look at a Fibonacci here, from here to here, is this just a small retracement? No, it's actually gone beyond the 61%. And also this very key level where it was rejected before. Look at this. It was rejected at that level, came back down, and now it's pushed out. It tried again. This is a daily chart, and pushed higher. The point being, if I look at this, there's nothing telling, what is telling you to short here from a technical perspective? That's a question. For me, nothing. And I go, okay, let me look at a few other things. Maybe I'm wrong here. So I'll start. This is the way I would do it. I'd look at a bunch of stochastics. I'll go, okay, the RSI, okay, it's getting up towards a level, but it's not crazy. Look at it, it's not at a crazy level. I go, okay. Then I would look at some like classical moving averages, EMAs. What is the trend telling you? It's very powerful uptrend. Okay, great.
And it just broke the trend line as well.
Yeah. Now, what about some shorter term ones? So let's go now for some shorter terms. So these are EMAs, but a lot shorter term. Okay, that's also, so the shorter term and the longer term EMAs are all in a powerful uptrend. I go, okay. Now I'm maybe going to look at Bollinger Bands. You go, well, maybe it's overextended. So let's look at Bollinger Bands. Okay, so
Or
on the
touching.
on the
But
daily
yeah.
Bollinger Band, it is at the top of the Bollinger Band, but it's not overextended as here. So you see here, it's not overextended. Now, on the Bollinger Bands, I also like to look at the weeklies, give me a bit more perspective. Now, because as you can see on the weekly Bollinger Band, normally it doesn't like to go outside the weekly Bollinger Band. Look what happened here. It extended and then it sold. Extended, still went up and had a pause. It generally, you see here. So the question here is that we are getting to, so here's my point, Danilo. The only technical indicator telling me to short is you could argue that the Bollinger Band on the weekly is, starting to get overextended. Okay, not on the daily. And finally, I have a personal thing which I like to use, which is a combination of momentum and all kinds of things. And what that is telling me is like, okay, yeah, it's getting close to the Bollinger Band. Is it overbought? You could argue yes, but it's not really giving me a reversal signal. You see the yellow ones is when all of these combination of MACDs and trends and everything gets. See, the yellow one is signaling danger for a reversal. Okay, it's not yet telling me that.
Point.
So at that point, so the first thing I would say is, in my experience, people have tried to short based on intervention many, many times over the last 4 or 5 years. Now, can they intervene and it will go down 200 or 300 ticks? Absolutely. Can you profit? Absolutely. The problem, sir, is timing. The problem is, okay, so the thing is, how can you short that on Japanese yen futures 6J? But that's very dangerous because at any given moment, the US dollar could continue for macroeconomic reasons, sorry, go higher. Or secondly, there could be some stupid Trump tweet causing the dollar to go higher. Or thirdly, just economic data. Let's say, for example, the employment number coming out on Thursday is super strong. The US dollar will go up and then boom, you're stopped out. So futures is difficult. Same thing for spot FX, so USD.JPY. So the point I'm trying to make is that any outright, do you understand the word outright, guys? When I say
No,
outright?
no, I don't. Outright, I know.
Outright is a way of saying a price, just the price as it is. So not a spread, not an option, just the price.
Okay. The price.
So if you're using 6J futures to short, okay, if you're using spot FX, it's okay, Danilo, but technically, to me, what the market normally likes to do, in my humble opinion and my experience, let me just clean this up. Sorry, get rid of this. Is test the new target. And I look at this, it's a powerful breakout. Now, can it stop? Of course it can stop. But what to me seems logical is that it maybe wants to test up here.
Yeah, me too.
And so for me, the risk reward. So what I'm trying to say, if you just want to short by using USD.JPY or the Japanese futures, this would make me a lot happier. I'd be a lot more comfortable because can you be wrong? Yeah, of course, you could be wrong. But your risk reward, like at least it's very clear. I would put an alert and just say, hey, like that way you're wrong. You could have a stop loss here and you say, okay, I'm wrong. Great. And at least, whereas now, why are you shorting here? Because the point I'm trying to make is that the intervention has happened. You want something more like this, where it reaches a level, it retests, and then comes down. And I personally think that, to be honest, can they intervene tomorrow and, it's suddenly down here tomorrow? You go, Angus, oh, I could have shorted. Okay, great. But I would personally, I'm saying from a technical perspective, there is almost nothing. There's zero evidence that this is anything other than a bull trend. It's bullish. In fact, I'd probably be looking for dips to buy, in theory, from a technical perspective. So if you would, okay, so, all right. But let's say, for example, you say, okay, that's great, Angus. But let's say it gets up to that level. I think the way to do it, there's an ETF. So you could use an ETF. What is it? Is it the Japanese yen ETF? Personally,
JPY, I think.
Yeah, it's no, it's called F something something. Hold on, let's look for it. It's not very liquid. I would probably use a. Let's try and find it, guys. Just perhaps I forgot. It's let's put maybe if we put yen. Yeah, I think it's YCL. I think it's YCL.
Yeah, this one for sure.
But this one looks like YCL. Okay, so you could use YCL and do it as an ETF. Now, the problem is also You could just buy that. The problem though is that the option chain is very illiquid on that. It's hard. The perfect way to do it, in my humble opinion, would be options on yen futures. That's how I trade this stuff. Right?
I'm not there yet, but
No, I
all
know,
the
but
info is amazing. It's I learned so much.
no, but what I'm trying to say is that I'll do probably at some point I'll do something on futures, options on futures, because a lot of you guys don't seem to use that. And the point is that the options on futures market is open 23 hours a day. Doesn't open at 9:30. So if you want to do something on NASDAQ, why not just do it on options on NASDAQ futures rather than the QQQs? That's my personal view. Same for oil, same for gold, same for bonds, same for short-term interest rates, same for FX. So, but that's a story for another day. Another way to do it, I would say, so let's say, for example, Daniel, it gets to that level a bit further up. You have a much better risk reward. So, can you buy that ETF? Can you just short the USD.JPY? Can you short the 6J futures? Yeah, you put a stop loss. Maybe you win, maybe you lose. No problem. That's a much better risk reward than where it is now. Now it's in the middle of no man's land. It's like, okay, maybe you get lucky. Trump says something. The Ministry of Finance in Japan says something. Maybe. But it's not a good trade. Got to be more patient. And historically, as I say, I've traded this many, many times, intervention, and everyone's always like, oh, they're going to intervene, they're going to intervene. And it goes, markets like to squeeze. Traders will squeeze that until maximum pain, which is going to be that point at 159 or 160, whatever it is. Now, the other way to do it on that ETF, what you could do there, I would actually buy a long put option, right? So buy a long put. And that way, your premium, you know what you're going to lose. If you want to risk $100 or $1 million, your premium is your maximum loss. And the point is then you can absorb some volatility. If you don't get the timing correct, and maybe for 3 or 4 days it goes high, you go, okay. That's a lot better than futures or the spot FX. Okay. Now, a more conservative way than a long put, you could do a long put spread, which is much more conservative, but it's going to be less painful. So you buy a long put, maybe at the money, and you do a short put, maybe with a delta, a bit further below of what you think the profit target could be. Maybe, a delta of 20, 25, or 30. And that's a conservative way. You're not going to make a huge amount of money, but you'll also control your heartbeat and your stress levels. And you can also, the point is, Daniel, you can do a lot more, you can absorb the volatility. So for me, the best instrument to express that would be wait to a better level, be patient, and some kind of option structure, maybe a long put on that ETF. But again, the option chain is not very liquid. It's a kind of a shitty, excuse the French, option chain. There's not much liquidity. It's okay.
Great. Thanks so much.
Yeah. But again, it's not the right level now. It's not the right level. The other thing as well is remember that that's USD.JPY. Keep an eye on the cross pairs. When you're trading currencies, look at the Japanese yen against the other cross pairs, because remember a general point on FX, guys. Most FX trades are essentially US dollar trades. Okay, even if we're doing Canadian dollar versus Japanese yen or something, at the end of the day, most of the liquidity and the energy, it's all caused by the US dollar. So the point is as well, Danilo, in terms of that shorting the Japanese yen, a lot of the trade, the idea, the rationale behind the trade is the US dollar. So you need to believe that the US dollar is weak. So I would argue that if you want to short the Japanese dollar based on possible or potential intervention, a more important, sorry guys, just 1 second. Hi Manoj. Hi Manoj. I'm just on a Zoom call. I'll be off in a few minutes. Can I give you a call back in a few minutes?
Yes, sir.
Thank you. Bye. Okay, yeah. So just keep in mind that all FX trades, very, very much, you must have a very clear view on the US dollar. Okay, so when you're thinking about your Japanese short, really think, is this the right moment to be shorting the US dollar? It's really almost more of a US dollar. So the other thing as well, Danilo, to help you get the right level is to be looking at the dollar index, because if the dollar index in general, the Dixie as we like to call it, which I assume you look at, see the dollar index here? You got this up? Oh, why is it not coming up? There we go. So the dollar index. Now that's, again, that's a more ambiguous chart. My point is that you would only be shorting the Japanese yen against the dollar. And this chart, again, this is sort of an uptrend. I mean, if I look at this Fibonacci, I mean, you could argue that the US dollar broke above 100, which is the purple line. It came back to the Fibonacci retracement, the 50% or the 61.8 from this most recent impulse, and it's now pushing up. In fact, if I had a Fibonacci measured move, the Fibonacci extension would be kind of to retest here and maybe even to push up into one of these zones. Again, my point is, and again, I'm just going to look at some technicals, is that the US dollar does this chart to me, this is an uptrend. Oh, it came back and immediately buyers came in and bought the Fibonacci retrace. So what I'm trying to say is that I'm not convinced by the US dollar Japanese yen technical chart. And if I look at the dollar index overall, it's not telling me to short the US dollar as well. So I'm like, oh. Now that could change with data, the Fed, everything could change in the next 2, 3, 4, 5 days. Because remember, we're going to start getting data and everything, right? And if we start getting weak economic data in the US, for sure, the sentiment could change. So my point, Danilo, is really be looking at that dollar index. You want to see the dollar in general showing whoa, just started like showing some consolidation, weakness, and that trend to start turning. If we go to this final thing, if we go to the short-term trends on the dollar here, and I'll look at these. So these are moving averages, guys, the short-term ones, right? It's still in an uptrend, but you want to be looking at the shorter-term moving averages here. Let's just see, just monitor this, no rush. But as you can see, it's still sort of in an uptrend. So I would say relax about that one for the moment. We still have a few more levels. And then if you want to do it, I would go with that ETF. Well, it depends. If you get that perfect level, Daniel, like what was that level? 158, 159 in USD.JPY. You know that recent high. That to me is an interesting level. It's a good technical trade. It's a good risk reward. You say, you know what? Maybe I'm wrong, but that's a nice level. Ideally, what you want to see is it spike above, quick rejection, boom, then you short. Spike above, quick rejection, US dollar flatlining, going weak, bad US data, boom. Because that's when the Ministry of Finance and the Bank of Japan will probably come in, because they're watching all of this, and they will maybe intervene at that point, and you'll wake up a rich man the next morning.
Thanks so much.
Okay, guys, I'm going to leave it there. Was that useful? Any sense that was a useful operation? Okay.
Oh, yeah.
Yes,
So we
It'd be
can,
great to
was
have that on a regular.
extremely.
okay, so what we can maybe do, guys, is to do that maybe once or twice a week, if that's useful. Hey, Rushdie.
Hi, Angus.
And
How are you? Sorry, it's because I was getting ready and I'm like heading to work right now, and
so
I know you're probably busy right now. We might talk later. I'm gonna send you a message.
I
Just
don't
want
like
information
Rushdie,
on
I don't
both
like
the things.
messages. You know that. I don't answer messages. I like to
Oh
do
yeah,
this.
yeah, yeah. So I gotta call you over Zoom or
No, you don't call me.
what's up, video call.
You wait till we do this group thing, and then you answer a question. Okay,
Oh,
mate,
okay,
we'll see.
okay. It's gonna
No, because
probably
I
next
know
time. Okay,
myself. I hate people say, "Oh,
gotcha,
explain the yield
gotcha,
curve."
Angus.
It's like a 5 hour email. I don't want to do it. But
Okay,
what we could possibly do, guys, if this is of any use, we can maybe do this once or twice a week and just come with some questions. I know that Jeremy still has questions about the yield curve and bonds and all that kind of stuff. That's a very big subject. But okay, this is the first one. We can maybe continue to do that into the future. Okay,
That would be great, Mangus. Thank you very much.
my pleasure, guys.
All
Hope
right,
that was
thank
useful.
you.
Talk
Take care,
soon.
everyone.
Ciao, guys.
This was
thank you.